Welcome to PIMCO Pod. In this episode, we discuss how behind the recent rally in energy credit lies a multi-year story of management discipline, restrained capital spending, and sector consolidation. Stay tuned after the conclusion of the podcast for additional important information. Energy Credit Market Returns Reflect Sector Discipline by Lotfi Karoui. Last week, despite seeing little tangible progress toward resolving the Iran conflict, U.S. markets quickly reverted to their familiar domestic anchors: AI capex optimism and the Federal Reserve outlook. It was, on balance, a strong week for risk markets, helped by renewed enthusiasm around AI spending and IPO demand, until Friday's post-payroll sell-off reminded investors that, in this market, good news can still be bad news. A stronger labor report prompted markets to reprice toward a more hawkish Fed, hiking interest rates as early as this year. This capped a week in which geopolitical tension mattered less than the usual mix of domestic micro and macro forces, particularly given already rich valuations in risk assets. The macro risks have not changed much. Either a growth slowdown driven by a lingering energy supply shock, or an overheating economy that pushes inflation higher and puts upward pressure on both yields and risk assets. Within credit markets, one sector that's shown ongoing strength amid macro turbulence is energy. Energy outperformance, more about credit discipline than higher oil prices. Since the conflict with Iran and the resulting supply shock pushed crude oil prices higher, energy credits have unsurprisingly outperformed their broader indices, including the Bloomberg U.S. Corporate High Yield Total Return Index, unhedged U.S. dollars, hereafter the USD-HY Index, and also the J.P. Morgan Emerging Market Bond Index, EMBI, Global Composite, excluding the countries of the Gulf Cooperation Council, or GCC. This outperformance actually began well before the recent oil spike. Higher prices have helped sustain spread tightening, especially in the USD-HY Index. But the bigger driver, in our view, has been the sector's shift toward a more disciplined, credit-friendly posture from a capital management standpoint, a trend that will likely persist. That shows up in three ways. First, unlike in past periods of rising oil prices, U.S. oil rig counts have remained relatively inelastic. Since the post-COVID recovery and the 2022 energy price spike, the number of operating U.S. oil rigs has been broadly stable despite large swings in oil prices. That is a sharp contrast with the pre-2020 period, when the relationship was much tighter and even more so relative to the pre-2015 wildcatting phase of the shale revolution. Some of this reflects better operational efficiency, but absent a prolonged period of elevated prices, near-term growth in rig counts still looks unlikely. Second, the dollar-denominated HY energy universe has consolidated materially since the shale boom peaked in 2014. In the past decade, the number of unique energy exploration and production E&P issuers in the USD-HY index has fallen from roughly 100, or about 9% of index par outstanding, to around 30, or roughly 3% today. But the broader energy sector still accounts for just over 10% of index market value. We believe this divergence largely reflects the growing share of integrated oil companies with exposure across the entire supply chain. As a result, sector earnings are less dependent on drilling activity alone. Disciplined drilling and consolidation have driven a multi-year deleveraging cycle. From 2014 through the COVID-induced default wave, the energy sector consistently carried higher net leverage than the broader USD-HY index. Since the 2020 defaults cleared out the weakest index-eligible names, however, leverage has improved and the sector has become a higher quality part of the HY market. We believe that dynamic should persist as higher energy prices support the sector's EBITDA, earnings before interest, taxes, depreciation, and amortization, while management teams remain reluctant to pursue large, debt-funded capex programs. Energy credit's oil beta is regime-dependent. A second way to show that credit-friendly capital management, rather than just higher oil prices, has driven outperformance in energy credit is to compare relative sector performance across different oil price regimes. We use $50 per barrel on the 12-month West Texas Intermediate, WTI, crude oil contract as an approximate break-even threshold for oil production. The monthly excess returns from being long HY energy versus the USD HY index above and below that threshold. The same exercise for emerging market EM corporates and EM sovereigns, using changes in spread differentials rather than excess returns. The takeaway for both HY and EM corporates is straightforward. Once oil prices are above break-even, further moves in oil tend to matter less for credit performance. In options terms, the put option embedded in energy firms' credit is then deep out of the money, so its delta is low and changes in oil prices have a smaller effect on spreads. Below break-even, the opposite is true. The energy sector becomes much more sensitive to oil prices, and relative performance beta rises materially. Interestingly, this relationship does not hold for oil-exporting EM sovereigns. Two factors help explain why. First, unlike corporates, sovereigns typically hold substantial US dollar reserves that help service external debt and reduce the risk of spread stress when oil prices fall. Second, EM sovereigns' effective fiscal break-even is often lower than that of EM corporates. They can continue to collect export revenues without the same immediate weakening in their cash flows or balance sheets. That makes sovereign spreads less mechanically tied to oil prices, especially over shorter horizons. Thank you for listening. That was Energy Credit Market Returns Reflect Sector Discipline. For future insights, please follow us on your favorite podcast platform. This episode uses an AI-generated voice. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable, but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.